Hey guys, welcome back to Stacking Stocks. Did you know that Tesla is Goldman Sachs' top pick for 2022? So then why is the stock still dropping anyway? Wall Street is getting more bullish about Tesla stock, but greater optimism among analysts hasn't been enough to lift the price, given fear of higher interest rates. Fears of rising interest rates are bad news for companies whose earnings are expected to grow rapidly in the future. The recent trading is a brutal reminder that part of the return of any stock, even Tesla, isn't determined by a company's individual fundamentals. Now let's see what the Goldman Sachs analyst has to say about this. So Goldman Sachs analyst Mark Delaney increased his price target for Tesla stock to $1,200 from $1,125, while maintaining a buy rating. Delaney also named Tesla a top pick for 2022. Delaney believes Tesla is the leader in electric vehicles and that EV trends are poised to accelerate in 2022, and the trends in the industry appear favorable. EV's shares of new car sales in China hit 20% late in 2021, while the figure in Europe is running above 10%. EV penetration in the U.S. is only at about 3% of new car sales, but there are more EV models reaching the U.S. market this year, including pickup trucks such as the Ford Motor F-150 Lightning, the Rivian Automotive R1T, and of course the Tesla Cybertruck. Still, price target increases don't always have as much impact as changes to analysts' ratings on stocks, and the big picture headwinds for growth stocks in general are formidable at the moment. Tesla stock was down in early trading as high growth stocks continue to be pummeled by fear of rising interest rates. Higher rates hurt highly valued growth stocks more than others because those companies are expected to generate most of their earnings and cash flow far in the future. The higher rates go, the less that cash is worth when it's discounted back into current terms, and the less investors may be willing to pay for those stocks. A second issue, which Delaney pointed out, is that EV sales won't grow as fast as he expects. That's a fundamental risk that's always present for the EV sector. Still, Delaney remains a Tesla bull. Overall, 45% of analysts rate Tesla shares buy, while the average buy rating ratio for stocks in the S&P 500 is about 55%. The average price target for Tesla stock among analysts is about $913 a share. Now that's up from about $662 only 3 months ago, but it's still roughly 10% below where the stock's trading. Wall Street's average price targets typically imply gains of about 10% for stocks in the S&P 500. Well, interest rate fears have completely wiped out the gain recorded on the first trading day of the year, after Tesla reported fourth quarter delivery figures that were far better than expected. But there's still much anticipation for Tesla to gain even more this year. Now the electric vehicle revolution is about to kick into high gear. Electric vehicle adoption is going to soar like never before this year, and EV stocks are going to skyrocket hundreds of percents. For starters, EVs are finally cheaper than gas-powered cars. An April 2021 report from the U.S. Department of Energy found that the all-in lifetime cost for a gas-fueled car is about $95,000, while the all-in lifetime cost for a similar EV is about $90,000. And there's a chance that the $95,000 figure for gas-fueled cars will likely rise in 2022 due to soaring fuel prices. Meanwhile, the cost for EVs should drop further thanks to economies of scale and falling battery costs. So gas-powered cars are no longer cost advantageous, but historically they've offered drivers a greater driving range than electric cars. Well, that advantage is now gone too. So a major wild card is whether or not Congress will pass new EV tax credits. That's key for Tesla and GM, which are no longer eligible for current federal tax credits of $7,500. All other automakers are still eligible at least through 2022. The new EV tax credits could allow Tesla to maintain or even raise prices further in the U.S., but the new EV tax credits were part of a broader spending package that is now in question. That could give Ford, Hyundai, and others a big price advantage versus Tesla EVs. For now, the Biden administration is pushing tougher emission standards that will effectively force traditional automakers, especially those with gas-guzzling full-size SUVs and pickups, to sell far more EVs and hybrids. There are no automakers that need government help right now, and EVs are selling well on their own. But this is a major positive catalyst for Tesla, General Motors, Ford, and other domestic EV manufacturers. If the EV tax credits pass as proposed, Tesla will likely come in far above current estimates, especially earlier in the year. Tesla being able to maintain the price and volume throughout the year will be key to watch since the Model 3 and Model Y are no longer new to the U.S. market. Tesla plans a massive expansion of its production capacity when it opens its factories outside Berlin and Austin, Texas in 2022. However, Tesla has no more major markets to enter and essentially no new vehicles. Meanwhile, competition continues to surge, with even the U.S. set to have a wide array of EV options, posing short and long-term threats to Tesla. Once Giga Berlin comes online and ramps production, will there be enough demand for both factories? Answering this question is going to be a key catalyst for Tesla in 2021. CEO Elon Musk had hoped to begin production at Tesla's German plant in Brandenburg near Berlin by the end of 2021, but Tesla is still waiting for final approval to begin production. When Berlin opens, the Model Y production ramp is expected to be slow. Tesla is reportedly expecting Gigafactory Berlin to make more than 30,000 vehicles in the first half of 2022. As Berlin picks up, Tesla's Shanghai will gradually wind down its Model Y exports to Europe, reserving more for local sales. 2022 is shaping up to be a terrific year for all EV manufacturers and especially for Tesla. The fundamental question, how far will it go? Still, Wall Street is optimistic about the electric vehicle makers' outlook as global spending on EVs explode and chip supply is expected to normalize. The chip shortage may have slowed Tesla's production growth, and many other automakers slashed output. That has provided tremendous pricing power to Tesla, which raised prices in the U.S. several times in 2021, and that helped beef up profit margins. The chip crunch shows signs that it's getting better. The global chip supply is up for the first time in months at leading suppliers, but demand is still sky high. Global automakers are just starting to boost production and inventories from low levels. Chip supply should begin to normalize in the longer term. The Omicron variant could offer another setback to chip and other supply chain woes if widespread shutdowns resume for an extended period of time. But what does this mean for Tesla stock? Are we looking at massive gains for investors throughout 2022? Shares surged 50% in 2021. Though it wasn't a straight advance to be sure, Tesla stock hit an all-time high of $1,243.49 on November 4th. But shares pulled back sharply when Musk polled his Twitter followers on November 6th about selling a 10% stake in the company. Elon has sold billions worth of Tesla stock since then, and it's unclear to what extent the Musk share sales have hurt Tesla stock and how much it simply reflects a broader market sell-off, with growth and EV plays hard hit. But what's clear is that Tesla intends to break the barriers in 2022. We expect to see the stock hitting new all-time highs this year. Tesla remains the EV giant that everyone is chasing. Tesla stock is a long-term winner with a market cap that dwarfs those of EV rivals and even traditional automakers. If Tesla sales continue to boom in 2022, with prices remaining high despite no new vehicles and facing significantly heightened competition, it'll cement the EV giant status as a long-term auto industry winner. As we've said before, watch out for Tesla in 2022. Anyway, thanks so much for tuning in today. Let us know your opinion via the comments section. Remember to like, share, and subscribe. See you next time right here on Stacking Stocks.